Okay, it's slowed down now, so we'll make a start. So hello, thanks for joining us for this Monitor Explained webinar, where we'll be taking a deeper dive into the first issue of Monitor 2023. This is EDF's quarterly report that gives you an up-to-date view of current non-energy costs. So I'll just start with some webinar housekeeping. So this session is being recorded. This is so that it can be shared with you after and with anyone who couldn't make the session today. If you have any questions, please submit these in the Q&A function throughout the presentations. As at the end of the presentations, there will be allocated time where I'll run through these with the experts. Any that we can't answer today, we'll take away after the session. So if you're a customer and haven't got your copy of Monitor just yet, you can access this helpful guide by logging in and signing up to EDF's Market Insight portal. The address is displayed here on the screen. The Market Insight portal is your gateway to regular updates and there to help you to make the right decisions for your business and to give you access to quality data and expert analysis to help you navigate a complex commodity market. So I'm Steve Spittle, Senior Manager of Mid-Market Planning and Support here at EDF, and I'll be hosting this session today. Joining me are technical experts from the Wholesale Market Services team. So we have David Edmonds, who's Senior Manager of Retail Services, Barney Gilmore, Commercial Lead in the Costac team, and Hugh Boyle, Costac Senior Analyst. So given the large fall in forward prices that we've seen in the wholesale markets, we're going to focus this webinar on slightly different topics compared to the last quarter. This quarter, we will be looking at changes that impact capacity market, contracts for difference, and balancing costs, otherwise known as BSUOS. So as I've already mentioned, wholesale prices have fallen a lot since our last update. So David, if we start with you, perhaps you could start with a quick overview on what has been happening in the markets.
Yeah, of course. So there's more detail that you can find on James Chaplin's Power Market webinar that he did a couple of weeks ago. So if you want to see in more detail, I'd suggest going and finding that on our website. But just give a quick overview as an introduction for this. So as you can see on the chart here, we've been seeing quite a significant fall in prices. This is looking at power prices looking forward. The last time we did a webinar was in early December. We're actually at a point sort of around here where prices had just been rising again. So there was a lot of uncertainty over where we could still see things outturn. But what we've seen since is quite a consistent fall in prices. That's predominantly be driven by, we've seen mild weather across the winter and a good gas supply coming in. That means gas storage is also in a very healthy position in Europe. And that means that there's less fear around gas shortages looking forward, although clearly there is still a risk that remains and we could see prices spike again. But at the moment of where we're seeing things is quite a good trend that we're seeing downwards, which is encouraging. In terms of what that does to the non-energy costs, in previous webinars, we've spent a lot of time talking about the relationship between balancing costs or BSUOS and CFD, or contract for difference, with wholesale prices. So you will see that shown on the charts at the top that there's been some quite significant changes in this edition of Monitor that's been driven by those falling prices. Generally speaking, it reduces our view of BSUOS and it increases our view of CFD. But the biggest thing that you'll probably notice is a narrowing range in those costs. And that's essentially saying we're more confident looking forward that we think there's perhaps a slightly lower range of wholesale prices that we could see versus where we were 3 or 6 months ago.
Okay. Thanks, David. So now we'll get to the main non-energy cost topics. So Hugh, so I think we've had some capacity market auctions in the last month. What are the key headlines from those?
Sure, Stephen, can talk through those. I guess for those who are a bit less familiar with it, a bit of background to the capacity market. These are in place to ensure security of supply by giving standby payments to generators to make sure they're there for when the wind's not blowing, the sun's not shining. And they National Grid does this by hosting auctions 4 years ahead of delivery called the T-4 auction to procure capacity in advance, and 1 year ahead of delivery, the T-1 auction, just to make up for any change in circumstances. You can see here on the screen as well, there's what's been happening over the past few years for both the T-1 and T-4 auctions, because they've both been quite interesting, the ones that happened in February. Starting with the T-1, so this procured 5.8 gigawatts of capacity at a clearing price of £60 a kilowatt. So that adds almost about £350 million to customer bills over 23-24. It's not a record high clearing price. So if you look at the previous T-1 in the middle of the left-hand chart, that cleared at the maximum price, £75 a kilowatt, because the target was higher than the participants participating in the auction. So everyone was a winner. This time the auction was very uncompetitive. There was only a few hundred megawatts of surplus capacity. So you only need a few participants to exit the auction for the auction to clear, which is why it's cleared at quite a high price. Again, I could see in absolute terms, I think it's a record amount of capacity procured at a T-1 auction, which is a conservative target post-Ukraine. And typically as well in T-1 auctions, you don't have very many natural participants. A lot of existing generators will lock in an agreement in the T-4 auction instead, and a lot of new build generators can't compete in the T-1 because you just can't build a big new gas plant in 1 year or less. So it's more like battery storage and demand side response units that are the new build that compete in these auctions. So a bit less competitive, which has resulted in that high clearing price, although broadly in line with our expectations, particularly following on from the record high clearing price last year. If you look at the main monitor report, you'll see that the range has narrowed considerably. It hasn't gone to zero because there are still a few things left out uncertain. So the T-4 auction payments are indexed to inflation. The cost is smeared over outturn demand, so we won't know what happens until next winter on that front. And there's potential for agreements to get terminated or for suppliers to exit the market and have small mutualization fees as well. But definitely a much narrower range, a lot more certainty in capacity market for next year following that auction. Looking now for the T-4, this was a record high price for the T-4 auction, cleared at £63 a kilowatt, and procured, like I say, the bulk of capacity is procured 4 years ahead of delivery. So 43 gigawatts was procured in this auction. So that will add about £2.7 billion to customer bills in 2026-27, and that will be uplifted. That's in 2021 prices, so that will get indexed to inflation. So it's a bit more like £3 billion, but uncertain for now. What's really driving this, so you can sort of see there's lower surpluses year on year for the past few years. So again, just a bit less competitive tension in the auction, which resulted in a higher clearing price. And if you sort of dig within the participating capacity, you see the year on year, the amount of, or the proportion of existing generation has fallen. You have older gas stations and nuclear stations closing down that won't be there in 2026-27. Those are being replaced by more expensive new build generations, such as the new build CCGT at Eggborough, which won a 15-year agreement in this auction. And those are just typically more expensive to support. It's possible as well, participants have been baking in sort of regulation change, sort of things like the JUOS SCR and the Review of Energy Market Arrangements, REMA, which may well be in effect by 2026-27.
So Hugh, there's some really high numbers there. Do you expect this to be a one-off, or for that to be a trend to continue?
Good question. So for the T-1, I'd say it's a lot less certain, particularly following Ukraine. There have been more conservative targets in the T-1 auction. Although, again, the T-1 does help you for changing circumstances from the T-4. So for instance, if there were unexpected power station closures, the anti-secure T-4 agreements, that capacity may have to be repurchased at the T-1 stage, so it could be very high or low. There's a lot more uncertainty there. Probably be prudent to budget for high clearing prices to continue in the T-1 auction, but much more clearer trend for the T-4 auction, where we know we have a lot of legacy, older gas and nuclear stations in the country that will reach end of life this decade, and those will typically expect to be replaced by new build capacity, which will be expensive. And as you can see, like, typically you need, even with all the other capacity in the CFD, RO, FIT markets that can't compete in the capacity market, we still require a lot of capacity, firm capacity really, in these T-4 auctions, and that's set to continue for the next few years as well. So T-4 definitely expect to remain high, and T-1 is a bit more uncertain, but like I say, prudent to budget for high prices to continue, definitely possible.
Great. Okay, thanks, you. I read in the Monitor report that there's been some changes to the way that Busios is going to be charged from April. Barney, are you able to give us some more information on that?
Yeah, of course. Just to introduce Busios before, I guess, Steve, you mentioned a little bit earlier. So Busios is the charge that recovers the cost of balancing the system minute to minute, hour to hour, making sure that supply and demand are always matched. I think we've probably seen in the Monitor report that historically this is quite a low cost, but there's quite substantial changes in the market years and over the last year in particular that have driven that upwards trend. So how do the wholesale market and Busios or balancing costs tie together? Well, the way that the balancing mechanism works, the large part of what Busios cost is asking generators essentially to turn up or turn down to ensure that that supply and demand are matched. And as wholesale prices trend upwards, the cost of, let's say, gas or in times coal trends up as well, and therefore the action that National Grid are asking a generator to take becomes more expensive. So as we see wholesale prices increase, we also see Busios costs increase as well. So given the energy crisis we've seen over the last couple of years, that has been one of the main drivers of Busios increasing up to this point. We haven't got the actuals on here, but in the Monitor report, which hopefully you've seen, we've got the last year of actuals as well. What we've actually seen is, although power prices have come down a little, as David showed at the beginning of the webinar, we've actually seen costs increase. So it just highlights just how uncertain Busios is and how tricky it is to forecast. So as I said, we would expect Busios to rise and fall with the wholesale market. Although the prompt prices have fallen, we've seen the effect of high wind and the impact of constraints means we're seeing higher Busios than perhaps would have been expected for those wholesale prices. And by constraints, I mean when there is too much wind in the likes of Scotland, where we see the majority of that wind capacity located. If there's too much wind and it's greater than the transmission capacity, the National Grid are forced to turn down some of that wind just to make sure that you don't start blowing up the transmission system. And they're quite expensive actions because generally wind farms will have subsidies. You're going to have to replace those subsidies for them if you're turning them off. And then likewise, if we're turning on expensive gas actions, you get another cost. So although we have seen wholesale prices trend down, we have seen very high costs recently. I think October or November was a record high month of about £13 a megawatt hour. So still really, really high costs, especially by historic standards. Just looking forward or looking in the current winter we're looking at, we were expecting high costs and there was some regulatory change that was brought in to help mitigate this a bit. So we mentioned last time CMP 395. This was a modification similar to one we saw last winter, or I think Q1 22, in which Busios costs were capped at £40 a megawatt hour. So the reason this was brought in was everyone was expecting very, very high balancing costs over winter, even higher than already mentioned. And the idea was to cap those extreme periods and defer those costs to be recovered next year. Now, costs have been high, but not quite as high as expected as those power prices have fallen. So there's been very little utilisation of that cap. I think there was around 250 million that was allowed to be deferred over the winter. I think we've seen about 1 million, probably about 1.5 million so far. So very low utilisation of that. But the benefit more generally is that Busios costs haven't been high enough to defer them. But generally, I guess the main point to bring out of that is there is a lot of uncertainty. You've seen our Busios ranges in previous Monitor webinars and reports. It's slightly narrower on this one, but you can still see that there is a very large range, and it just highlights how hard it is to forecast Busios depending on what the weather's doing, what power prices do between the point of forecast and the point of delivery. So it's a very tricky non-energy cost to forecast. I guess one thing to highlight that is the power prices are uncertain, but David's mentioned before, we often see this offsetting effects between Busios and CFD. So I've talked about how Busios rises with wholesale power prices, but CFD is inversely proportional to power prices. So we would expect costs to come down on Busios with falling prices and CFD to go up and vice versa. Just coming back to that range in our forecast then. So as a lot of you will know, National Grid have released their tariffs for the next year under CMP 361. This fixes BSUOS for summer and winter at those rates shown there, about £13.40 for summer and just over £14 for winter. I think one thing to note about that is that upper range we still have there is very high for two reasons. One is that we've got to remember there's another piece of regulatory change coming in from April 23, which is CMP 308. And this changes the charging base for BSUOS from both the generators and demand, which is currently to final demand only, so essentially halving the charging base. So by historic standards, you can assume that rates should essentially double from April 23 onwards. But also in addition to that, we have a view that costs could outturn higher than the rate that National Grid have fixed it at. And National Grid only have a certain amount of buffer of how much higher costs can outturn than the rate they've set. Essentially, they have to get the money in to pay the generators that they're asking to turn up and down. So as I said, it's very uncertain with BSUOS. If wholesale prices were to rise dramatically again, if we were to see very high wind or very low demand that made balancing the system very tricky over summer and the coming winter, costs could outturn a lot higher than the rate that National Grid are receiving money in, and it may be that they reopen. So although they are fixed, there is a risk that depending on prevailing market conditions, that cost could be out, those rates could be opened up and could outturn, in our opinion, as high as a kind of £35 range. But worth noting that £35 by historic standards is more like a £15 to £18 range, given the halving in the charging base. Just touching back on those fixed rates a bit more then. So CMP 361 was the modification that fixed it. The variation on that modification that they approved was that it'd be a 6 months fix, which is how you can see those 2 seasons fixed, with a 9 months lead. So we already know summer and winter this year, and we'll find out the summer 24 tariff 9 months ahead of delivery. I think one thing also to highlight is that if rates aren't reopened, but there's an over and under recovery versus those fixed rates, any under or over recovery is then pushed forward into future years. So if National Grid recover too much, it's not that it just stays with National Grid, it gets pushed forward into future tariffs and the costs brought down, and vice versa if they under recover. So I think the general message is BSUOS is a very tricky forecast to make. You've got the impacts of wholesale market conditions, the likes of wind and demand driving BSUOS costs. So even though things have been slightly better in certain areas than we might have expected, there's been offsetting effects. We've had regulatory change being announced and coming in from April 23, both CMP 308 and 361. But we've still got a range going forward depending on where we see market conditions outturning.
Great, thanks, Barney. So we now move on to the final topic that we're going to cover today, which is CFD costs. So, David, over to you.
Yeah, I think just make a couple more points on BSUOS, and I've seen one question's come in the Q&A that we can pick up there. So, I guess first point is obviously with these new fixed rates for BSUOS at National Grid setting, it is new, and when you're looking at comparing prices and quotes that you're seeing, particularly for fixed price contracts, you do need to be careful of what suppliers are assuming. It will take a little bit of time, I think, for this to bed in across the industry and for people to understand exactly how it's all going to work and what the risks are involved with it. So there may not be like for like offerings out there, which add some complexity and can make things difficult. I think the other points, the questions come in around how much notice National Grid have to give in order to open up the fixed BSUOS rates you need. I don't think there's actually anything official in terms of a time frame that they have to do, but when we've been speaking to them, the point they've made is this could materialize very quickly if we see a spike in costs. So certainly if we look back to the highest cost periods, we've seen days where there's been sort of 60, 70 million pounds of cost a day that can come through. If that was to be sustained for any period of time, 300 million pounds may not last that long. So National Grid do need the ability to open up rates very quickly. So it could be that there's very little notice because the consequences of them running out of cash, not being able to pay generators to keep the system in balance would be very severe. So no sort of set time frame as such, but it could happen quite quickly if it needs to. One other point I'll say is on that with Q&A, do send questions through. I think we may be having a few audio issues, so if you missed any points, please ask questions through the Q&A and we'll pick up at the end as well. And also the topic I'm about to talk about can be a little bit complex, so we'll intentionally let it to the end in case there are any questions that people want to send in as we talk about it. So moving on to CFD, as we've already mentioned, CFD related to wholesale prices in terms of where we expect the cost to be. So the CFD cost comes from there being a payment to generators that are on the scheme or from generators that are on the scheme, but that payment is designed to take them from a market reference price back to a fixed strike price. So if market prices are higher than the strike price of a generator, they will make payment to bring them back to that strike price. If market prices are lower than their strike price, they will receive a payment to bring them back to that strike price. Where we've been seeing prices falling, that's meant our forecast in general been increasing for CFD. But there is also a secondary effect, that's something I want to talk about, that has had quite a big impact over the winter that we're just coming to the end of, and we also set to have impact looking forward as well. So this is looking at baseload generators on the CFD. Often we'll talk about the CFD talking about wind farms next to the dead price. In this instance, talking about mass generation, and there's two main generators CFD scheme, Lynmouth and Drax. Drax, the main one that's been generating more recently, so where some data we focused on. The way it works based on generators is they're not indexed to a day ahead price, they're indexed to an average season ahead price over the previous season. So for this current winter, what that means is the generator will have been, in theory, selling a small amount of their expected generation every day across the previous summer. So what, 182nd of volume every day, to achieve the average price of the winter 22 product across summer 22. The CFD mechanism then assumes that that is how they've been selling a generation, but then there needs to be payment to bring them back to their strike price. And let's say that's around £130 a megawatt hour. So the payment that will happen if been hedging for this current winter, then achieve a price of £405 a megawatt hour, as shown on the slide. But then they will have to make a payment of, say, £275 a megawatt hour to bring them back to their strike price of 130 if they generate. They'll also have fuel and running costs if they generate, which their strike price is designed to cover, and it should still be profitable for them to do that when receiving their strike price. The problem of here, though, is that there is a second option that CFD generators don't have to generate. They can choose not to generate. If they do that, though, they will have to rebalance their position to bring them back to reflect that they're not going to generate and have zero volume sold at the end of it. So they will need to buy back what they previously sold. We've been seeing big falls in prices, and again on average we've seen around £150 a megawatt hour day ahead prices outturning. That gives them an option to buy back the generation quite cheaply relative to how they've sold it. So that becomes the profitable decision for them to make. This is all within the design of the scheme, and it's something that they're able to do. But the issue it causes for supplier costs and customer costs is it means that there's that payment coming back through the CFD scheme from generators to suppliers. So the CFD revenue decreases, which is the same as the cost increasing. So that means we've been seeing lower payments come through for this winter. And because prices have also been falling for the coming summer, we expect that to continue for the summer as well, and could happen in future if we see further big price decreases as we approach a season. So that's all reflected in our cost. It's another interesting dynamic we've been seeing from market changing, and having never seen such large decreases in market prices as we're seeing at the moment. So we thought just a topic that was worth covering in this webinar. It's quite a big cost movement.
Right, thanks, David. Apologies, I think there was some connection issues there, but it did seem to improve. So hopefully, it's resolved itself now. So now we'll move on to the Q&A. We did have some questions up front, so I'll start with those. So firstly, for several years now, the government has been using contracts for difference to set a strike price for electricity generated by larger renewable energy installations. Has this helped to mitigate in any way at all the rising price of electricity caused by high international gas prices? And is the impact of CFDs likely to increase as the capacity of renewable generation increases and the strike prices come down? Sorry, a long question
there. I don't know if you'll be able to hear me because it's definitely cutting out for me now in trying to hear you. I think that the answer is yes. As we've covered, there is an offset there in the way that the CFD scheme happens. It's a relatively small one because it's a relatively small proportion of national generation that's on the CFD scheme. So it's not anywhere near as big as the movement in power prices that we see. As we see more generation on the CFD scheme, we would expect the offset to increase as well as more national generations through that scheme.
Right, thank you. So I'll pose the next question to Hugh. So there was a large increase in TNUoS costs flagged in the report. Is there any more detail on why that has happened?
Unfortunately, not a great amount of detail. So just to give a bit of background to this, National Grid published its draft TNUoS tax for the April 23 year at the end of November last year. It then published its final tax at the end of January. So not much time difference, but in between those snapshots, it increased the amount of allowed revenue it would recover through TNUoS tax by £450 million. So more than a 10% increase on the sort of underlying £4 billion it was expected to recover. Various breakdowns in communication between sort of the National Grid TO, the transmission system operator, and ESO, the electricity system operator. Potentially some of it's related to under recovery in 21 and 22 financial years, but no great answers yet. And it's fairly unprecedented. I think the most we've seen before in change in revenue is left definitely under 100 million. And that was during a change in price control period where it was a bit more expected. So some questions still need to be answered on that. So unfortunately it is a big increase in revenue, and those are fixed final tariffs now for the April 23 year. So I think that £450 million is broadly equal to about £1.50 a megawatt hour, £1.50 a megawatt hour, apologies, increase in tariffs if it was recovered volumetrically. However, because it's revenue, it will just be recovered through the residual tariff. So it will go into the fixed pence per site per day charges coming in from April 2023. So the impact will be a bit more customer specific depending on your banding.
Thank you. And as always, there's been a couple of questions relating to TCR and standing charges changing. So rather than answer these individually, could you just give a quick overview of the TCR changes and when they will impact bills?
Sure. Yeah, no, this is always very topical. So the TCR's targeted charging review was reform of the DUOS and TNUoS residual charges, which were previously recovered volumetrically and are now moving to these fixed charges pence per site per day, making them unavoidable, particularly with a nod to TNUoS tariffs, where previously half-hourly customers could engage in triad avoidance and avoid their TNUoS liability, and that increases costs for other users. So this reform removes that opportunity. It has already come in for DUOS, so it came in for DUOS tariffs in April 22 financial year, and the impact varies depending on which part of the country you're in. So the residual can range from sort of negative in London to, I think, sort of up to sort of 30 to 50% of total GEOS costs in some DNO areas. For Chinuos, the change is coming in April this year, and it is about 90% of Chinuos revenue is recovered through the residual. So the vast majority of customers' Chinuos tariffs now will be recovered on a fixed basis rather than a volumetric basis. From April 23, there will still be a small charge depending on where you are in the country. So for instance, in Scotland and Northern English areas, there is no variable element anymore. It is just a fixed cost for Chinuos, but in some of the more southern areas, particularly sort of the southwest, London, southeast, southern GSPs, there is a small charge either in the 4 to 7 periods year round for non-half hourly customers, or during the triad periods for half hourly customers will remain, but much smaller magnitude than it's been in previous years.
Right, thank you. We've had a couple of questions come through. So the first is on BSUOS. So do the fixed BSUOS rates include for the CMP 308 change to demand-only collection? So are we going to end up paying twice for BSUOS? So surely it must be included in commodity rates.
I can take that one. It's a good question. So I guess just to go back onto what CMP 308 does is essentially halves the charging base for BSUOS and moves it to demand. So yes, BSUOS rates for customers do double, but what it means is it's no longer a cost for generators. And what that means is if a generator used to have to price in, say, £10 into the cost of their generation, they no longer have that cost, so they can bring their cost of generation down by, let's say, £10. So essentially, you're moving whether you pay the cost within your wholesale price that that is achieved in the market to moving it through BSUOS costs. So in aggregate, a supplier will pay the same amount of BSUOS costs. It's just where it's being represented. So there shouldn't be a double counting or double charging of BSUOS. One thing that is worth I'd say taking that question just one step further is the impact of how CMP 395, the deferral of costs, works with the fact that we're deferring costs at the moment over winter 22, both from generators and demand, and then it's going to be recovered across the fixed rates across April 23, across summer and winter. Now, any costs that were deferred from generators will be recovered from generators separately. So only half, or essentially about half of the costs that are deferred will be recovered from demand customers. So I guess to summarize, CMP 308 won't double charge customers. It's just moving where you see that cost being recovered from, and any deferred costs will be recovered correctly. So there shouldn't be, the idea of the changes is not to have any adverse effect on demand customers.
Thank you. Another question is, will reconciliations be performed quicker with the new changes? So a lot of customers had very high charges 18 months later, which was unforecasted.
I guess I can give this a go. It's hard to know exactly what might be asked. Potentially it's about mutualization, which has been a common theme on the renewables obligation scheme in particular since 2017-18. And because the renewables obligation is not settled until the October after the financial year has ended, you can sometimes end up getting a very large increase in costs after the fact. That's not, so that could be one thing. A lot of suppliers have exited the market in the 21-22 financial year. So far, none have exited the market in the 22-23 year. Although, again, that liability is completely held by suppliers and not paid until October. So if a supplier still exits between now and October, there could still be RO mutualization for the 22-23 year, which could end up in a high cost in arrears. I don't know if the customers potentially mentioning things like BSUOS, there will still be the reconciliation run process, but that will only really happen if National Grid has reopened its tariff, or for very small things like demand changes. And that's customer demand, not the tariff. So the tariff is fixed. If National Grid doesn't reopen it, there shouldn't be a reconciliation, which may help. But there will still be a reconciliation process for meter reading updates and that sort of thing, which will still go on for, I think it's normally 14 months by standard after the fact is what they call the reconciliation final settlement run.
Right, thanks, you. We've got another question.
Sorry, just.
Oh, sorry, David.
So I was just going to add to that. So specifically for the BSIL changes, I think because of the risk that the rates could very well get opened up and outturn differently up until the end of the winter, it's almost no real change to the reconciliation process specifically from that, because you're still going to have an outturn rate potentially in the same way that you do today.
Great. Thank you. We've got a question here on the climate change levy, so I'm not sure if it will be one for you guys, but I'll ask it anyway, just in case. So do you have an outlook on climate change levy and associated discount for climate change agreement members for 2025 and beyond? If it's not one, you could actually, we'll take that one away.
Yeah, it's not an area of responsibility for our team, but happy to take that away and look into it.
And then we've got another question here regarding BSIOS. So what are the chances of tariffs being reopened? Did I read that the tariffs are set at the P99s?
Yes, it's a good question from Adam. It's a good point. There were different ideas as to what level it should be set at. The kind of P99 was talked about. In the end, no BSIOS, what they call a BSIOS fund, was included. So it's essentially set at their central view. Now, the reason they did this was twofold. One is to keep costs down to consumers. They don't want to be overcharging and bringing forward any costs to de-risk the fact that the rates are fixed. The second is that National Grid have a working capital allowance of 300 million, which we mentioned. So there is already a bit of buffer that National Grid already have internally. So instead of asking that from customers, they're using that themselves. The trade-off of not having that is that if costs outturn a lot higher, we're more likely to reopen. So at the moment, I think there is a reasonable chance that costs could outturn higher than it's set. And that is partially driven by how market dynamics are done, but also the fact that as there's no BSIOS fund, it's only that 300 million allowance that National Grid has as a buffer. So a good question.
Great, thank you. So I think that's all of the questions that we've had. So so thanks for those questions, and thank you to all of our presenters for sharing their insights today. If we didn't get to answer anything, or there are other areas you'd like to understand, then please feel free to get in touch. The details are here on the screen now. For those of you who have any questions or want to know more around the UK power market, we'll be hosting our next webinar, which will be with our energy trader, James Chaplin. This will be on Wednesday, the 25th of May. And you can sign up to this as well as the future webinars if you just head over to edfenergy.com and the Talk Power events page. That's where you'll go to register. To stay in touch with all the latest industry news and updates from EDF, please follow us on our dedicated EDF Business Solutions LinkedIn page. And yeah, that's it. So thanks again for joining. We'll share the recording with you later, and have a good day. Thank you.
Yeah, thanks for hosting us, Steve, and apologies for the IT problems.